£41,000. That is what one widow lost because nobody told her about a form. Her husband died in March. She had until March 2 years later to submit it. Nobody mentioned the form. The bereavement letters came and went. The solicitor handled the probate. The window closed quietly. The transferred threshold was gone permanently. The tax bill on her estate was £41,000 higher than it needed to be. There are 6 deadlines HMRC expects every widow to know. None of them will arrive in a letter. I spent 29 years inside HMRC, 8 of those in the Pensions and Investments Compliance Unit, then as a senior investigator, then on the team that wrote the guidance inspectors used when the rules became complicated. I have sat across tables at Citizens' Advice from widows who did everything right, saved carefully, paid their taxes, and still lost thousands to a form nobody thought to mention. I'm not on the payroll anymore, which means I can finally say a few things I wasn't allowed to say before. 1. The ISA wrapper on your late spouse's money is temporary. You have 3 years to save it. When your husband or wife dies and leaves you their ISA, most people assume the tax-free status passes with it. It does for now. The ISA stays intact while the estate is being settled, but the clock starts the day they die. And here's the bit nobody explains. When your spouse dies, you are entitled to something called the Additional Permitted Subscription, the APS. It is a one-off, extra ISA allowance equal to the full value of your late spouse's ISA at the date of their death. If their ISA was worth £75,000, you receive a separate one-off allowance of £75,000 on top of your own annual £20,000. You do not have to take the same investments. You subscribe fresh cash into your own ISA up to that amount, and the tax-free wrapper on that money is preserved in your hands permanently. But you have 3 years from the date of death to claim it, or 180 days after the estate administration is complete, whichever is later. After that point, the allowance vanishes. No extension, no appeal, no discretion at HMRC. The tax-free wrapper on that money is simply gone. I sat with a woman called Janet at Citizens' Advice, 73 years old. Her husband had died 18 months earlier, leaving an ISA worth £68,000. She had never heard of the APS. She found out about it during a conversation about something else entirely. She had 18 months of allowance left. "What if I hadn't come in today?" she asked. I didn't have a good answer. Don't be Janet. Ring your ISA provider today. Say exactly this: "My late husband had an ISA with you. Am I eligible for an additional permitted subscription, and what do I need to do to claim it?" Those exact words. Most providers have a process for it. Most widows have simply never asked. Scotland. The APS applies UK-wide. The process and deadline are identical in Scotland. Right. 2. The transferred nil rate band must be claimed. Miss the deadline and it is gone forever. When the first spouse dies and leaves everything to the survivor, their entire nil rate band goes unused. The nil rate band is £325,000 per person. Because nothing taxable passed at the first death, that £325,000 transfers to the surviving spouse's estate. The combined standard nil rate band is £650,000. And if the home passes to direct descendants, the resident's nil rate band adds up to £350,000 on top. Total potential threshold, £1 million. And here's the bit nobody explains. That transfer does not happen automatically. The executors of the surviving spouse's estate must actively claim it using a form called the IHT 402, filed alongside the main inheritance tax return after the second death. And it must be submitted within 2 years of the month in which the surviving spouse died. 2 years sounds comfortable. Grief is slow. Probate is slow. HMRC will not remind you. Miss the deadline and the transferred band is gone permanently. A tax bill that could have been 0 becomes something else. I sat with a man called Robert at a Pensionwise session, 68 years old. His wife had died the previous year. He was beginning to think about his own estate planning. He had never heard of the IHT 402. His solicitor had not raised it. "So my wife's threshold just disappears if my executors don't know to claim it?" he said. "Yes, that is exactly what happens. Don't be Robert's executors. Speak to your solicitor this week. Ask specifically, are you aware of the IHT 402 to claim the transferred nil rate band, and will you be submitting it as part of your probate service? If they hesitate, find someone who does not." Scotland. Inheritance tax is a UK-wide tax. The IHT 402 and the 2-year deadline apply in Scotland as they do in England and Wales. The Scottish term for probate is confirmation, but the form and the deadline are identical. Now. 3. Your pension nomination form points to a dead man. Fix it today. When your spouse dies, one thing happens almost universally. The survivor inherits everything: the house, the savings, the ISA. And then they sit down and update nothing. And here's the bit nobody explains. Your pension death benefit is paid at the discretion of the scheme trustees, guided by your nomination form, sometimes called an expression of wish. It is not legally binding, which is precisely what keeps it outside the inheritance tax estate. But trustees take it seriously. If your nomination form still names your late spouse, the trustees will make their own decision about who receives the death benefit. That might still be the right outcome, or it might not be. You have given away control of one of the most significant financial decisions you can make for the people you love. I sat with a woman I'll call Dorothy at Citizens Advice, 70 years old, widowed the previous spring. She had a SIPP worth £190,000. The nomination form had not been touched in 11 years. It named her husband. The pension company sent a bereavement letter, she said. Nobody mentioned the nomination form. Nobody does. Don't be Dorothy. Ring your pension provider today. Say, I was recently widowed. I'd like to review and update my expression of wish on this pension. Can you tell me how to do that? 10 minutes. Free. Do this before anything else on this list. Scotland. Pension nominations apply UK-wide. The process and the urgency are identical in Scotland. Right. 4. The annual gift exemption resets every April. Miss 2 years in a row and one of them is gone. Every individual in this country can give away £3,000 per year, completely free of inheritance tax. No 7-year clock, no form. Exempt outright from the moment it leaves your account. For a widow living alone, this is the most immediate tool available to reduce the taxable estate. And most widows are not using it. And here's the bit nobody explains. The carry-forward rule is narrower than most people realize. If you did not use last year's allowance, you can carry it forward, but only once. Miss 2 tax years in a row and the first is permanently gone. And there is a second exemption almost nobody mentions. Regular gifts from surplus income, not from capital, but from income you genuinely do not need, are entirely exempt from inheritance tax with no upper limit, no clock, no form. The gifts must be regular, habitual, and must not affect your standard of living. Keep a record. HMRC will ask for it. I sat with a woman called Margaret at Pensionwise, 74 years old, widowed 2 years earlier. She had £240,000 in savings. Her pension covered all her costs with money to spare. She had given nothing to her children since her husband died. 2 full years of annual exemption, gone permanently. We always meant to start, she said. He was going to look into it. He was always the one who dealt with that sort of thing. Don't be Margaret. Start this tax year. Give £3,000 or up to £6,000 if last year's allowance is still available. Keep 1 notebook page per gift. The date, the amount, the recipient. HMRC will ask for it and it costs you nothing to record it now. Scotland. The annual gift exemption and the gifts from surplus income exemption both apply UK-wide. Same rules, same records, same April 5th deadline. Now. 5. The residence nil rate band requires the right will. Yours may not have the right words. The residence nil rate band is worth £175,000 per person. For a widow, that adds up to £350,000 of additional threshold when the home eventually passes to the estate. But it does not apply automatically, and the wording of your existing will may not be sufficient to secure it. And here's the bit nobody explains. The residence nil rate band only attaches if the main home passes to a direct descendant, a child, stepchild, or grandchild, not a sibling, not a niece, a direct descendant. After the first spouse dies, most surviving spouses update nothing. The will they made together may have been drafted before the residence nil rate band existed in 2017, or the wording may be ambiguous, or a trust may inadvertently block the property from reaching direct descendants. The ban may not apply in full, that is £175,000 of threshold lost. At 40%, that is £70,000 to HMRC that did not have to go there. I sat with a woman called Helen at Citizens Advice, 69 years old, widowed 6 months earlier. Her estate was worth £820,000, mostly the house. She had a will, drafted 12 years ago. When I asked whether it specifically directed the property to her children on her death, she did not know. My solicitor said everything was in order, she told me. In order is not the same as specific. Don't be Helen. Ring your solicitor this month. Ask, does my current will specifically direct my main home to my direct descendants on my death in a way that preserves the residence nil rate band in full? Ask for the answer in writing. Scotland. The residence nil rate band applies UK-wide, but Scottish succession law differs in important ways. Take specific Scottish legal advice rather than applying English assumptions. Right. 6. April 2027. Changes the pension picture permanently. The clock is already running. For decades, unused DC pension wealth sat entirely outside the inheritance tax estate. Pension death benefits are paid at trustee discretion, not as of legal right. They did not form part of the estate. A SIPP worth £300,000, properly nominated, passed to children with no inheritance tax at all. And here's the bit nobody explains. From the 6th of April 2027, 11 months from now, unused defined contribution pensions will be brought inside the inheritance tax estate. For a widow whose husband's pension has just passed to her tax-free under the spousal exemption, the question is, what happens when she dies? Under the new rules, her own DC pension sits inside the taxable estate. If her estate has already consumed its threshold, every pound faces 40%. Die over 75, and the children also pay income tax at their marginal rate on every pound they draw from the inherited pot. 2 taxes on the same money. That is not an accident. That is policy. I sat with a woman I'll call Christine at Pensionwise this year, 67 years old. Her husband had died the previous summer. His SIPP had passed to her intact under the spousal exemption. She had her own SIPP worth £210,000. She had not updated her nomination form since they married. She did not know about April 2027. So the rules are changing while I'm still grieving, she said. Yes, and the deadline does not care. Don't be Christine in March 2027. Ring your pension provider this week. Say, I was recently widowed. I need to update my expression of wish, and I'd also like to understand how the April 2027 inheritance tax changes affect my pension. 20 minutes. Free. Then book a session with a qualified independent financial advisor and ask, how does the April 2027 pension IHT change affect my estate plan? Scotland. Pension inheritance tax applies UK-wide from April 2027. The same deadline and the same rules apply in Scotland. The system runs on what you ask for, not on what you're owed. Claim the APS before 3 years runs out. Make sure your executors know about the IHT 402 and the 2-year window. Update the pension nomination this week. Use the gift exemption this tax year and start the surplus income record today. Get the will reviewed this month. Start the pension IHT conversation now, Not in March 2027. That is where we started. £41,000. A tax bill that should not have existed. A form called the IHT 402. An allowance transferred by law, claimed by nobody, lost permanently. The same thing happens to thousands of estates every single year, quietly and permanently, because nobody thought to send the letter explaining any of it. These are not loopholes. They are the rules. They are written into law, available to every family in this country, and they disappear without trace when nobody knows to claim them. Take care of yourselves, and take care of the people you'd leave behind. I should say, as I always do, nearly 30 years inside HMRC and now a citizen's advice volunteer. Nothing here is regulated financial advice. For your specific circumstances, particularly estate planning and pension, IHT, speak with a qualified independent financial advisor and a solicitor. If you have a defined contribution pension, book a free Pensionwise appointment first. Government-backed, for the over 50s. The number is 0800113797. All links are in the description.